there are some things you could be doing in the midst of the market turmoil.
Oh, that are extremely positive for you.
Yes. And one of which is tax loss harvesting. And that term alone, you think, well, who wants losses in their portfolio?
I do.
You don't want a loss in your portfolio. But if you have something temporarily declined in value,
you're going to recognize that loss.
It'd be nice if you can lock that loss in to offset gains of other things.
You don't inherently purchase something because you expect a loss in it. That is not investing. But inevitably, if you're an investor, you're going to own something outside of an IRA or a qualified plan that has lost value. And you have two choices. One is you can just continue to hold it. The other is you can sell it, recognize the loss for tax purposes, and purchase something similar but not identical on the same day that you, right? You can't buy the same thing because then it's called the wash rule, and you can't recognize the loss.
And it's really easy to do if you, let's say you invested January 1st of this year in just even some ETFs, it'd be easy to swap some things out. Take some losses, but at the beginning, because as we're preparing for the show, I said to Pat, "Yeah, it's really hard to. It's really hard to do on things that you've owned for years and years." And you said, "Oh no, I just encountered.
Just saw one, which is it was a pretty big account. It was north of $5 million. They had the same advisor for the last 20 some odd years." Purchasing the same mutual funds from the same family, right? And dividend reinvestment. So what is dividend reinvestment?
What percentage was in this one particular mutual fund?
Family or
the family?
I think it was 70+%.
Was this like old front-loaded mutual funds that were sold? That was how things were done 30 years ago?
Like you mean the American funds like when you and I started? Like that?
Something like that.
Was that? Right? Yes, it was something like that. It was old school. This is how we do it old school. We don't change. We dividend reinvest because it's the best thing ever. Look.
So dividend reinvestment in the last 12 months.
Lost money. You take a loss. You sell that portion of the portfolio. So what is dividend reinvestment?
Well, the dividends that the mutual fund, in this case was a mutual fund, or ETFs or stocks, you reinvest it back within itself, which is
they pay out.
Not always the best thing to do.
It's
in a tax deferred account, qualified account.
Yeah, it's fine.
Makes sense. In a account that's outside of retirement accounts where you're trying to minimize taxes, it's usually not the best thing to do.
Yes, it's lazy. It's lazy. That's what it is, right? Because
it is easy, yes.
It is easy.
Yes. And a lot of stocks used to have the DRIPs, dividend reinvestment plans, right in them.
Yes. Anyway, so if you've got an opportunity to recognize losses, and it's right there on your statement, if you're managing your own portfolio, then it's easy to see.
Or your advisor. And you can allocate which shares you want to sell. You own 100 shares, and you say, I want to sell the 2 shares that were purchased on these dates.
Yes, and that way you could recognize the loss on those. So it in a downturn market,
and you can sell it and then buy something very similar that same day. So you're not out of the market,
but not identical.
Yeah, you're not out of the market.
Yes. So it makes sense. And if you've got a good advisor, they're doing that for you anyway.